Ladies and gentlemen, welcome to By the Horns, a Bitcoin podcast about South Africa. And this evening we are joined by a returning guest for the third time, Matthew Daneel. We're very happy to have you. Matt, we're going to talk all about financial products once again because the show was so well received 4 weeks ago. And we're also joined by the lovely Jade Kramer to chat about offshore investments. And then obviously we're going to circle back around. Unlike Jen Psaki, we're actually going to get back around to how Bitcoin works and how it ties into financial products. Should you go offshore? Should you go into Bitcoin? What's the deal? It's going to be quite an illuminating one. It's quite a big topic. So let's jump right in. Guys, welcome to the show.
Great. Thanks so much, Ricky. Thanks for having me.
Pleasure.
Nice to be here.
Welcome back, Matt. Good to see you again.
Yeah, good to be back. I'm waiting for my loyalty points. You can pay me in Lightning later.
Yeah, you have to get your referral code, bro. Yeah, guys, so let's do a quick introduction to people who haven't watched the previous episodes. If you don't know who Matt is, I suggest go watch episode 21 and episode number 1. We did a dive into financial products and what the state of financial products in South Africa is. But Matt, you want to give a quick overview of who you are, just so people know?
Yeah, I mean, firstly, it's good to be back. I think the last show we did was really well received, and excited to get sort of a deeper dive into. We basically ran out of time, so I'm excited to get a deeper dive into it. But yeah, basically, I'm a financial planner. That's my day job with a Bitcoin hobby. And that's pretty much it. I've got, I think, a slightly different approach to most financial planners. I'm not, I don't have my blinkers on. So yeah, that's pretty much me. I think the rest of catch up on episode 21 and yeah.
Great. And Jade, if you mind telling us a bit about yourself, who you are, where you're from, what work you do, your background, etc.
Okay, sure. So I'm an offshore wealth manager. I started off in the local space. But as Matt, I think, and you guys were discussing last time, there's no one size fits all. You can't necessarily rely on everything just being in South Africa. So I think that's why my eyes were open to the offshore space. A lot of clients were asking for it. And yeah, so I'm an independent offshore wealth manager. So we have licenses pretty much with every company or, fund manager in the world. So, which is quite nice. And there's no one size fits all though. So, I mean, you mentioned Bitcoin versus offshore. I think it's obviously you can't put everything into one thing. So I think diversifying is key. So yeah, as you said, obviously it's a bit risky. It's not for everyone. So it's just understanding those risks and, having a part of your portfolio.
Absolutely. Okay, great. Cool. Right. So on the previous podcast, we chatted all about the current existing financial products within South Africa. So what people have, retirement annuities, tax-free savings accounts, endowments, all of that. We're going to do like a very brief synopsis of them. The long and short of it is you've really, really, really got to watch out. You can get caught up in a product that has a 25-year time frame, 30-year time frame on it. You can pay massive fees upfront to pay your advisor's commission, essentially, and that reduces the performance of your investment over the long term. So you end up with a really poorly performing investment, and you're stuck. You can't get out. You pay exit fees, all of this, and in the interim, you could have bought Bitcoin. Is really what it came down to for us. But so the point of today's show is to really dive a little bit deeper into which financial products that exist are actually worth it in your guys' professional opinion. Once again, let's put this out there. This is not financial advice, guys. We're trying to cover everyone, even though both of you are registered financial advisors. Myself and Brandon are no longer, so we don't want to be playing in that game. But yeah, this is just a general discussion around it. However, we want to get into some other options like offshore, etc., because these kind of offer a interesting take and an interesting investment space for people to be in. They've given pretty good returns over the last decade as compared to local assets. So yeah, we want to dive into that. So Matt, you're looking at these products now with the eyes of a Bitcoiner and a financial planner. With reference to the ones we discussed last time, your RAs, your tax-free savings, your rainy day funds, etc. Which products do you think warrant a second look from Bitcoiners that they should actually be spending a bit of time becoming acquainted with?
Yeah, I mean, something Jay said earlier, I mean, there is no one size fits all, but I think diversification is key. And yeah, it depends on your sort of appetite for risk, right? I know guys that are, heavily deep into Bitcoin because they fully understand it and they're, well versed on it. So, their appetite for risk is they can stomach the volatility, they can deal with it. And so they've got, more exposure to Bitcoin. And that's that's their personal preference and that's their kind of approach. For me, often my clients come to me and they are not as well educated or well versed. So for me, it's kind of I come in from an education standpoint. And then you've got to look at their, what's their ability to stomach the volatility that comes with Bitcoin. You're not going to get amazing gains with, little volatility. With the big gains comes the big volatility, and you've got to kind of understand that. So yeah, I mean, as we said, I can't really advise on how much Bitcoin to add into your portfolio. I can educate it on it, and then it's kind of from you that, I can take you to the water, but you got to drink. And yeah, so from my perspective, what I try and do is build sort of just a well-diversified portfolio for my clients. I think traditionally we grew up, we're hearing about retirement annuities. I think that's the thing you've got to do. From the day one, you got to start your retirement annuity. And I think that's kind of an old school approach. And I think that's vastly changing in the advice world. People are learning that's not a very flexible product, and you're very limited in how you can invest with that product. And because of the limitations, you also experience limited growth. So the longer I've been in the industry, I've kind of realized this. And I think that's where I started to just have a different approach. So for me, I kind of think, tax-free savings, you're in fiat, it's a very low sort of point of entry. You can only do a maximum of 36,000 Rand a year and you get tax-free growth. So to me, that's kind of like point number one. That's what I would feel. That's somebody said to me, what do I do? I'd say, okay, tax-free saving is your first point of call. But again, this is a very general, everyone is different. And not everyone sees themselves in South Africa in 10 years' time. Some people see that, that everything is South Africa is the best place in the world, and other people are doubtful. So again, it's just it's a very general approach. But a tax-free savings, I think, is a good thing because tax-free. And from that standpoint, you want to maximize growth as much as possible. So aggressive funds. Yeah,
Matt, on the tax-free savings with most investors, are they looking long-term or short-term on that? Because are they buying long-term? So they're buying more equity funds in that, right?
Yeah, absolutely. More aggressive approach because you want to maximize the tax-free advantage, right? So if you're going to go into conservative funds and get limited growth, you're not going to win so much on the tax side, right? So you want to go as much as possible, be as aggressive as possible, and you want to look long-term. It's almost like a secondary, more flexible retirement vehicle. That's where I would see it.
Do you think that limitation, what is it, 500,000 Rand for your life? What is it now? Is that what it still is?
Yeah.
Do you think Do you think that'll increase in the next 3-5 years?
Yeah. I think they'll have to. They've slowly increased your annual allowance each year, but because the tax-free is quite a new thing, no one has got to that 500,000 point yet because there hasn't been enough years of tax-free savings availability yet. So I think once we start to approach that point, they might have to raise it a little bit. But I think for the moment, try and maximize your annual allowance. It's a flexible investment, so if you need to go anywhere and you pack your bags, you can take it with you and go. So that's the point number one for me.
So Matt, the biggest culprit for screwing investors over, the biggest financial product has been the culprit number one for screwing people over in the long term thus far has been retirement annuities because of the way they're structured, right? Because they're inflexible and because the money is locked for so long, advisors have taken those upfront fees and that's what's reduced the yield. The same is not really true for tax-free savings accounts because they aren't structured as an endowment. And the endowment part is key here. And this is really what screws everyone over, is because the endowments, it's like a wrapper. That means it's a life product really, right? So you can't actually access your funds for 5 years. They haven't done that with a tax-free saving, or no company I've seen has managed to put a tax-free saving in an endowment yet. Thank God. I'm sure they'll try, but they haven't yet. So just based on that alone, you end up with a much more flexible product. But separate from those two, where do you see a rainy day fund fitting into this whole play, and how would you structure that?
So a rainy day fund for me should be sort of in a conservative portfolio because you want something that it's precisely that, it's there for rainy days. So something happens, an unplanned or unforeseen event, you need quick access to funds. So you need to have it in an account where you've got easy access, not something that you're stuck for 5 years or whatever the case is, like the endowment you mentioned. And you want to have it in a portfolio that's fairly conservative. So when you need to pull the funds, you're not, your funds haven't dropped. There's not a lot of volatility. So to me, a rainy day fund should be sort of in an income fund with steady growth, where you're still beating inflation. And if you need to access the funds quickly, you don't have to worry about, potentially, the funds having dropped to a lower value, and you have to sell off more units to get your money out. So yeah, that would be second point after a tax-free is having a rainy day fund.
So talk me through the actual structure of a rainy day fund. Like, would you have it on a list platform like Alan Gray or a Glacier or something like that? And then what do you mean when you say an income fund? Just so the listeners know exactly what you're talking about.
Cool. So on a list platform. So a list platform is standard unit trust. It's not something like Ricky mentioned earlier as a life wrapper where you're tied in for certain periods. So you've got easy access to your funds. Fees are relatively low as well. And generally on a rainy day fund, if you need to withdraw your funds from once you submit the paperwork, it's probably a 3 to 4 day, maybe a 5 day turnaround, and you've got your funds back. And that's in a standard unit trust product. So that's an actual investment.
Okay, and then how much do you recommend people put in the rainy day fund? Like, how do you figure out like what's enough?
It varies, I think, from perhaps maybe a self-employed person to a salaried person, but I would say at an absolute minimum, say 3 months worth of monthly income. Jade, I don't know if you would agree.
Yeah, normally 3 to 6 months.
Yeah, 3 to 6 months. I was just going to say, I think that's a nice. If you can afford the 6 months, great. But everyone's situation is different.
So 3 to 6 months of salary or of expenses? Because for some people, 6 months of salary is it's a lot of money, to accumulate that amount of funds in a rainy day fund is going to take you a while.
Yeah, exactly. Yeah, so I think it's something that you can cover your expenses. At the very least, cover your expenses and a bit on top for living costs and that kind of stuff. So yeah, I think that's probably a good way to put it.
Okay, so like if your food bill is $5,000 and your rent is $10,000 and your insurances, etc., all of that adds up to another $5,000. You need like $20,000 for the month to survive times 3, so you need $60,000 in a rainy day fund.
Yeah. And okay. I mean, it's something I do with all my clients, is I make sure that they understand their spending habits and understand what the expenses are, because that all fits into the plan. Because if you can understand it, you can also manage it, and you can plan better.
Yeah, I remember seeing when I worked in financial services and I worked on the other side of advisors. So I saw the great side of you guys. Basically, they would divide portfolios, like lisp accounts, because it costs hardly anything. And they'll say like just a 500 Rand debit all into that, just say for car maintenance. And they would just have like 10 lisp accounts. But, as a way to show, maybe it does show like a lot of work for the clients in a very plastic manner. But I thought it was interesting. So they could they understand how to, which money to take out at what time.
Brandon, on that point though, having separate Lisp accounts, having been there myself, not all Lisp platforms are equal, right? So for example, some of them, and I don't want to mention any names, but there's a big bank that owns an investment house in South Africa. They've got a blue logo. And their Lisp platform is dog shit. It is so bad. So when you go and create separate Lisp like accounts for your clients, you can't name them. So it's just like random account numbers. And then when you pull a statement, it confuses all of them. So you might have you've set up like a wedding savings fund and a rainy day fund and like a holiday fund. You've done all this work for the client. You've literally, and the paperwork it's like mountains of paperwork. You've done all this stuff. And then the platform goes and confuses everything. And it's a complete nightmare. Then you have to sit for years with your clients trying to figure it out after the fact. It's terrible. So I think what I'm getting to is that the advisors, sometimes it is it's a thankless job in some aspects, because you end up doing all of this paperwork that no one knows, and it's just like pushed on you by the government, by the regulations, and you have to do all this nonsense paperwork for the sake of it, and then you make $5,000 a month out of
it.
Yeah.
But
I think that you've changed a lot, Ricky, since you've been in it. The amount of compliance and paperwork and stuff, which is good though. I mean, especially with the offshore stuff, it's pretty much. I mean, I think I did a fund selection. It was 45 documents just for the funds. So, which is good though, because it means you're not going to sign up, 400 people a month. You'll maybe only sign up 1 or 2, and you actually take your job. You have to take it a lot more seriously. So unfortunately, you can't run around for, if you're going to make £5,000 a month on something, which is also good. I think a lot of the old school advisors have left just out of that. The industry's changed a lot though, which is good for everyone else on the other side of it.
Yeah, but I'm gonna push back a bit on that. So like all the regulation, all the compliance, and all of that has come into the industry, there are still advisors today selling endowment style products to clients, and clients are still getting screwed over. And I know you two don't do that, obviously, but like there's still advisors out there today peddling this nonsense, and it's because the incentive structure hasn't changed. It's still based on upfront commission, which comes out of the effective annual return of the client's funds paid upfront as a loan, essentially. And that skews all the incentives of the industry. So they can do all the compliance in the world they want. If they don't change that, you're still going to get bad outcomes, unfortunately. In my opinion.
And I think
RDR, Matt. Do you know what's happening there? Because I mean, they keep talking about it.
Yeah, it's actually I've kind of turned a sort of blind eye to the RDR stuff at the moment. So RDR is a new regulation where it's going to be more fee-based rather than commission, like upfront commission. But yeah, I mean, my business is pretty much I'm pushing more on the investment side where it's fee-based anyway, so I'm not as stressed about it.
Yeah, so I remember in 2017 when I was working in this industry, Brandon, I'm not sure you were there a little bit earlier before me, but they were talking about RDR like it was coming tomorrow back then already, you know? So obviously they've kicked the can down the road as much as possible because the big players in the industry, the big life insurance companies don't really want RDR because it's going to destroy their monetization model.
Can you guys for our viewers just explain RDR a bit more?
Yeah, so at the moment, how it works in the industry is a lot of advisors survive off like a big upfront commission, which at the end of the day comes out of the client's pocket, right? So, you know, it's not really a client's hand. Then you get more salesman type people than actual advisors because they're going to just sell, and then what's going to earn them the most money. So what RDR is basically the fee-based approach where you have an arrangement with your client saying, okay, you charge a monthly fee for advice, or if you're going to see me, you charge a consultation fee. So it's more like a professional setup where you go see a doctor, you pay, you know, a once-off fee for advice, and that's kind of it. So that's what they're pushing for. So it's essentially a more professional setup, and then it's going to favor an advisor that actually gives proper advice because he's going to offer his clients value, and the client will return, and obviously that's how he makes his fee. So yeah, that's how I understand RDR.
Yeah. I mean, it's come into play in the UK, and I mean, I don't know how many thousands of Yariki, you're nodding. How many people, you know, just dropped out of the industry after that? So it'll be interesting to see if that comes into play here.
Yeah.
So my fiance's dad is my soon-to-be father-in-law is a wealth manager in the UK, and he's been in the industry for 20 years. He actually works for Investec in the UK because they've got offices there. So the Investec bought the firm that he ran. But so I spoke to him about this and the way it's structured, the industry is structured in South Africa. And he's like, yeah, it used to be like that in the UK in the 80s. And then they reformed the industry quite slowly as well. But then there was like a mass exodus of the used car salesman type of advisors. The hucksters got washed out because if you're giving bad advice and your clients' funds aren't performing, then you don't make any money. So it is a professionalizing aspect. However, in South Africa, it's like they keep talking about it and nothing happens. They just make you do more paperwork, which doesn't fix the problem.
Yeah.
Anyway.
I think the industry is changing though, and I think like due to shows like this where there's a platform for advisors to discuss to educate essentially listeners. After the last show we did, I had some really good feedback, and the one guy actually messaged me. He's a friend of mine in Cape Town, and he's sort of loosely involved in the industry, but more on the back end side. And he was just like, finally somebody said something. He's like, finally somebody actually stood up and said what's going on. And he was like, it was really, really cool. And he was well impressed by it. He was like, no one really speaks out. It's like this unwritten thing that everyone kind of accepts that's how it is, and no one says anything.
So, I mean, we haven't got a lawsuit yet. So I think once that happens, we succeeded, right?
Yeah. You guys deal with that though.
We'll take care of it.
Yeah.
I mean, we won't be laughing then, but I mean, we'll cross that bridge when we get to it. But okay, so we've covered rainy day funds. We've touched on tax frees and RAs. I want to get into two really interesting ones for me. So, Jade, before we get into the offshore stuff, I would like to get your guys' take on real estate. So, real estate, you obviously have two options. You've got physical real estate, you've got listed real estate. that you can invest in through a financial product. Over the last 30 years in South Africa, real estate has performed really well. But over the last 10 years, it's slowed down. Over the last 5 years, it's done badly. And over the last 2 years, especially if you're in Umhlanga, it's done really badly. So maybe not 2 years in Umhlanga, maybe like the last 3 months. But this is the thing. So real estate, we grew up with our parents and everyone around us being like, invest in property. You know, you can earn a residual income off your property and then leverage that up with the loan you've got and the equity in the property to buy another property, and then you roll them over and then you build yourself a property empire. Yeah, is the theory behind it. What are your guys' thoughts?
Matt, do you want to say something first?
Yeah, I mean, I agree with Ricky. That's how you kind of grow up. I think, you know, everyone's dream is white picket fence in a house, 2.2 kids and a Labrador. But I think and this is where South Africa is a unique country. I think over the years, there's been sort of less and less confidence. And remember, when you're buying a house, you're in for 25, 30 years potentially. And a lot of people potentially don't have that faith in South Africa for that long. So I think that's a big change in the market, is that, people are a bit more hesitant to spend on property. And as you said, are the returns still there? Well, there's a lot of doubt about that as well. And yeah, I mean, that's one of the reasons we decided to get sort of Jade involved in the show as well. And something that I'm also sort of exploring for my business as well is, a lot of I sort of clients immediately develop a financial plan, and a lot of them believe in property, and that's how they grew up. And I need to make sure that we've got a robust plan in place. And if I'm less confident in South Africa, well, I need to be able to give them other options. So I'm not as well versed in it yet, but I am looking at being able to offer my clients offshore property, where I think there's less of a political risk. So if they still want to get into the property market, there is options, and I think that's where Jade can really add value to today's conversation.
Yeah.
But before we go there, and sorry to jump in on this one, Jade, but before we get into the offshore property, can we just discuss the two options? Obviously, everyone knows physical property, listed property in South Africa. Can you explain that concept a bit more, Matt?
So listed property, essentially, you're not directly in hard property per se in your own name, but you are buying into property via a fund. So you can be part of a standalone property fund, and they're invested in Sandton City, for example, because that's owned by Liberty. So that's a big part, and they've traditionally done pretty well. But if you look at property fund returns over the last few years, well, you're in for quite a shock.
So on that point, do you have kind of segmented property funds that aren't just in the different types of properties, office, commercial, private property, whatever, residential? Do you have segmented ones that are specifically like just commercial property? Because Growth Point is kind of in many different types of properties. Do we have? Are there rates or funds that are in just residential?
I think generally, I'm not aware of one that's like specifically a residential or specifically a commercial. I think generally they've got a split. Some fund managers might favor one over the other, and that's depending on their sort of approach to the market and their belief in the market. But yeah, I'm not aware of like one that's sort of specific, residential property focused.
I mean, because I don't think offices are going to do well anytime soon.
Yeah. So,
Yeah.
So that's the thing, right? Is that a knock-on effect? So at the moment, the office space is struggling. No one's renting offices because everyone's working from home, right? So what's happening? There's an oversupply of office space. So what's going to happen is they're going to develop that into residential, and then there's going to be an oversupply of residential, and so it's going to be like a knock-on effect. And suddenly, when residential prices drop because now we've got too much residential property, and we've got a commercial as well. No one wants commercial anymore, so everything. So my view on property actually is not very positive at this moment.
Okay, so that whole soliloquy that you just went through, if you replace the word property with money, you just explain the fucking central bank system.
Yeah.
Yeah. So I mean, a personal story of mine. I've actually got a piece of property that I'm trying to sell, and it's been a struggle liquidity wise. Property is, I can tell you from first-hand experience, not the place to be at the moment.
Jade, what's your view on local property?
Local property, pretty much what you were saying, is not too positive. To be fair, I wouldn't buy, myself personally, but my own opinion, I wouldn't buy property here at the moment. But offshore, 100%. I would definitely advocate that. So we have a whole property arm specifically for clients, like let's say they're in their 30s or even 40s or 50s. You guys were talking about retirement savings earlier. Instead of taking on RA here, we're looking at rather putting that towards property offshore. As you said, leveraging. You can't go to the bank and go leverage an investment, whereas at least there you can get extremely low interest rates. Property prices aren't actually as bad as people think offshore property is. So we only look at places with a hard currency, so nowhere with an R. So we wouldn't look at Rand, Ruby, Rupee, Rupee, anything with an R. So that immediately takes South Africa, unfortunately, out of the equation. As soon as they start saying things like land expropriation without compensation, we also take that out of the equation. So South Africa, unfortunately.
So Berlin is out off the table as well for you guys then.
No, Berlin is amazing. Berlin's unbelievable.
Well, Berlin just passed the expropriation without compensation bill, 3 days ago?
No ways.
Yeah.
This is news to us.
So I read about that actually, yeah. But I think because...
Is it the whole economy or is it just one specific large landlord? Maybe we need to double check that though.
No, it's not Germany. It's not Germany wide. It's just Berlin. So it's just in the city. And it's not even one large landlord. It's all large. If you own over a certain amount of units, then but this is the thin end of the wedge, right? So Germany's coming off that list.
Yeah.
So maybe I don't know. I don't know. I can hop in here because I think I read that same article, and I think what's happened is that there's certain companies in Berlin that's basically they've got almost like a monopoly, and so they can charge whatever they want for rent, right? Because they own such a large majority of the accommodation, and that's been a crisis in Berlin is like the rental costs and trying to get an affordable place to live. And I think that's what they're trying to prevent. I think it's I don't know what they're actually going to do, how it's all going to work, but I think that's what they're trying to prevent.
Because they had a rental on a couple of, I don't know if you saw that.
I'm going to wager.
We can look at the bad side of that, I think, naturally, because I think we're all capitalists here and we rationalists as well. But there's the good side because in China as well, there's 3 or 4 extremely large developers that have an extreme monopoly on the whole economy, and there's bad things happening because of that, as we've seen. There's a good and bad.
I'm going to wager a bet here, though. I know nothing about the history of this, but this is probably going to turn out to be correct. And the fact that there's one large owner of property in Berlin is probably, you're going to look far enough back, there was probably some government intervention that led to that single property owner owning so much property. He got preferential treatment at some point. Like if you show me a distortion in the market, I'll show you some previous regulation that was put in place to fix something else that caused the fuck up. And that's probably what happened. I mean, I'd be happy to be proven wrong on this, but I have a feeling this is probably what happened.
That'll be in the next podcast.
Yeah, we will. But Jade, just coming. So you're a Zimbabwean. You were born in Zimbabwe, right?
No, but my mom's side of the family, yeah.
Okay, so you've seen expropriation without compensation up close and personal in the family, and you understand that when people talk about property and about being like immovable and it's it's something no one can take away from you, that's a lie.
Exactly that. Yeah, no, so that's why, I mean, there's nothing wrong with South Africa. I think you can live a great life here. I'm not saying sell here and move and do anything like that. But if you have an offshore investment, whether anything, not necessarily just property, but if you're living here with a hard currency, I think you're in the best place in the world. We're in the land of opportunity, but it's just literally, I mean, Ricky, if I can ask you, if I had to give you a scale of 0 to 100, 0 being the Zimbabwe route, the thing we just spoke about, or 100 being Singapore, where do you see South Africa going in the next 5 to 10 years? What is if you had to put a number on it?
Well, trending towards Zimbabwe, that's for sure.
Okay. Yeah. So, what number would you give it? A 3? Would you give it a 4? A 1?
Well, if it's 0 to 10, I'd probably say South Africa is probably somewhere between a 3 and a 4, probably.
Okay. So, I mean, that's less than a flip of a coin as to what's going to happen here. Why leave all your eggs in one basket, essentially? So you should then have 70% of your assets offshore, somewhere where, there's no sovereign debt. There's, all those things. But you can still live here, So it's just about getting, as we mentioned earlier, diversification, not just all in property, not just all in Bitcoin, not just all in income funds or whatever the case is. It's about, essentially having all of those boxes ticked.
So Jade, on the sovereign debt fronts, what are the best countries with the lowest, debt to GDP ratios?
We mainly go places with strong links to the UK, so Guernsey, Isle of Man, Malta, Gibraltar, those those countries where there's government backing also. So if something happens to the actual investment, the government gives you backing on your investment. Where we don't have that in South Africa at all. I mean, Matt, you can correct me on the number. I think it's not even 100,000 Rand that they'll give you back. I think it's way less. I mean, it was something ridiculous. I can't even remember how much they'll give you if you lose literally all your money. Hey, how much?
No, I'm just saying that's the maximum they'll give you, regardless of how much you lost.
Yeah. Whereas
can I ask?
It's like 80% they'll back your investment, the government.
Shit, that's pretty good. Can I ask a hypothetical question? If you didn't have Reg 28 and you didn't have your discretionary allowance, would you have all your money offshore?
Me?
Yes.
No. Yes.
Yeah, I probably would. I mean, I get like to this asset class breakdown. If you look after over the last 10 years, over the last 15 years, over the last 5 years, global equity has outperformed pretty much every other asset class.
So on that front, right? Okay, let's dive deep into that. So if you were to just take as much money offshore in increments because of your allowance, would you place quite a bit in a diversified manner, like some in the offshore money markets, some in equities and all that? I'm assuming you are advising clients to do that, right?
Yeah.
Exactly. It depends on their risk profile, right? We've got to, unfortunately, due to regulation and stuff, I can't just cowboy YOLO, chuck you into equities and like roll on. So you've got to look at a bigger picture of the client. Again, their appetite for risk. I've got a client who just wanted to park some money offshore because he was going, he was immigrating to the States. And he just wanted to buy some dollars, park it offshore in a conservative fund because he wanted to, once he gets to the other side, he'll withdraw it on that side, which you can do. So then obviously it's a different approach. You don't go into equities and that kind of stuff.
What are the fees like? Oh, sorry. First of all, what's the minimum? What are the standard minimums like at your Alan Gray, Coronation, and all those guys? So, what's Orbis and etc.
So,
Matt, I mean, you do that. That's local offshore. Yeah. Hey? That's not offshore.
Exactly. So so just to sort of differentiate Jade and myself, Jade's offshore is very much not via a South African domiciled country like Alan Gray, for example. So Alan Gray is South African and they've got an office in South Africa and then they've got an offshore arm basically, and you're invested in US dollars, but essentially via Alan Gray's offshore platform. That's something that I do currently.
Like your global equity feeder fund, right?
Or your Orbis, your Bailey Gifford.
So it's Orbis, kind of but Orbis, that's offshore. That's like actual dollars offshore, isn't it?
You're in dollars. Yeah, exactly. Yeah.
Okay.
And then you've got a 50,000 Rand lump sum minimum. They don't have, as yet, they don't have the ability to go debit order monthly offshore. It's not available yet on a platform that I'm aware of. Jade can chat. She's got something potentially for that she can mention later on. But I know it's in the pipeline, but I know it's not available yet. But I think pretty much you can look at a 50,000 Rand lump sum minimum to go offshore, and then they convert that into US dollars, and you actually go into hard currency in an international fund.
So now you put, let's just call it 100,000 Rand to make it easy. Take your guys' fees out of it. What are the fees you're looking at with these fund managers in terms of performance fees, ongoing fees, any Forex fees? What are we looking at there?
So generally, we'll actually see potentially lower fees on the international side of things because there's more competition. In South Africa, we have far fewer fund managers, less competition, so your fees are slightly higher. Again, that is actually changing. I've seen quite a few funds quite recently dropping their fees, but we're still not at international sort of level and competitiveness. So from an international perspective, it ranges quite a bit, again, from fund manager to fund manager and their personal approach. You can see 0.7, 0.8, and then a few potentially over 1%. It depends, and that's from active managers, right? That's not from passive funds.
Sorry, is that like what is that? The monthly fee? Is that the annual fee? How is that charged?
That is an annual fee. So that is the investment manager's annual fee. This is purely from a fund perspective. As an advisor, I take a 0.5% ongoing fee, which is added, of course, on top of that. So if you look there's a platform fee as well. So again, there's a lot of fees, but this is all very transparent from an investment perspective when you're working with investment companies, right? With your Acrays, your 91, your Glaciers, it's very transparent. So you can see an actual breakdown. It's called an EAC. You can see the manager's fees. You can see the advice fee that your advisor is charging you. You can see administration fee for the company that administers your investment. And generally, you want to end up probably in about a 2% region, plus minus 2%, and I think that's fair. From if you're dealing with a life company, which is your non-investment companies, the guys that also sell you life cover, then you're looking at a whole different fee category, and you're probably going to pay double.
Then you're going to have fun staying put.
Yeah. Then you're going to, and that comes off your growth, right? So then you're not looking at 2%, you're probably looking at 5%. And you can't touch your investment for the next 5 to 10 or 15 years. But again, that's episode 21. So.
Sure.
And then Jade, so what's the difference between what you do then and what Matt does with your offshore, the type of offshore products you work with?
Yeah, so I'll literally, it'll be offshore. So it won't be like an asset swap or investing offshore through a local company. It's directly offshore. The funds are offshore. So they'll be sitting in a hard currency in that country. So let's say the UK, and then we'll invest on a platform exactly like you would here, like a normal unit trust. You can do that. And the fees are actually extremely low. Obviously, there's hundreds of different companies. It depends on what the client wants. But the main reason why we look at offshore is for tax structuring purposes. So we'll set up a structural vehicle, whatever the case is, and then underneath that we'll put a platform. So there's obviously, as I said, there's no one size fits all, and it's also not for everyone. The minimum is around $100,000 or pounds, depending on what they want to do, just because there's set fees. So anything above it becomes less and less, as a percentage. But in that vehicle, they can invest in pretty much any fund in the world. It's completely bespoke. So if they want to be 100% in equities, they can. There's no regulation or anything like that. They could be in multiple currencies. So it's very different that's essentially like a pension vehicle for the tax benefits, but it's not like a normal pension here where you can't access it. It's, the 1/3, 2/3, all of that, nonsense that they have here. And there's no, you can literally invest in any fund in the world in those vehicles.
So all these offshore, let's just look at offshore still, right? Because I just think that you need to get out of the rand no matter what. What is the perfect offshore hedge against Bitcoin? Because you're saying if you buy Bitcoin, you need to diversify a portfolio. I don't believe that. I don't see anything else but Bitcoin, but I'm either very stupid or very clever and nothing in between.
You're just a maxi.
I'm a maxi. I swear I'm either a very big idiot or very smart, and we'll find out in the very near future.
Yeah.
But how do you hedge Bitcoin still in the offshore manner? What would you do?
Cheapers. Matt, what do you think? That's quite a question here. What can you even compare?
Yeah, so obviously, if you look at Bitcoin returns over 10 years, right, it literally blows everything out the water. So it's very hard to do like a direct comparison of like, okay, how do we recreate Bitcoin in an offshore way? I don't think you can really do it, right? It's tough, but not everybody has, I want to say, the balls to go 100% into Bitcoin like you might have. And it's a bit, you're young. You've got the ability to take on that risk. An older person like my mom, for example, would I want to put 100% Bitcoin? Well, I wouldn't put 100% Bitcoin at all. But would I want to in an offshore pension structure, something that Jade does? Absolutely. And that's just purely based on her risk profile. She doesn't have as long to go as potentially you that can ride out the Bitcoin wave and really see it. When I think about Bitcoin, I'm thinking long term. I don't care about the short term volatility. I'm thinking 25 years time. Does my mom have 25 years? Well, I don't know. And then so an offshore pension structure, something like that Jay deals with, yes. But it's all about finding that balance. I'm a financial advisor. I deal with this stuff daily, and I have a fair percentage of my portfolio in Bitcoin, and that's just my personal belief.
Yeah.
Okay, so my thoughts on this is that you want to hedge your volatility, really. If you're gonna go and hedge yourself. I'm in the same boat as Brandon. I used to be an advisor. I understand how all this all works, but I'm 100%, almost 100%, besides my rainy day fund in Bitcoin. And that's essentially my hedge, right? Now, I think you do the same in an offshore structure. you try to hedge your volatility because Bitcoin is hyper volatile. So you want something that is less volatile, but is still giving you upside on the foreign currency side. So maybe like a bond fund or something like US dollar, get some T-bills or whatever. I mean, if you want to donate your money to inflation, you can go and do that. But really, you're using it as a hedge against volatility. Would be my thinking. If you go equities, you're going to get the upside, but you're going to get volatility as well. Not as much as Bitcoin, but you're still going to get volatility. Yeah. So I don't know if equities are the right mix there.
Yeah, I mean, you could go stable coin, right? And there's now 70 trillion in Tether alone. I mean, that's considerable, guys. Like the stable coin market has grown 3 times PayPal in 6 months.
How much did you say?
It's like 70 trillion or 70 billion.
70 billion.
Sorry.
Yeah.
But you could do that because if Bitcoin something happens and it goes down dramatically, you'll see actual Tether or USDC go to like 1.05, which is weird because I mean there's so much demand for it. But if Tether turns out to be a fraud, Bitcoin goes down and that goes down.
Yeah,
and you're fucked. Yeah. So that's the risk there.
I mean, you could do a stable coin with yield, like USDC or whatever, but then you're going the custodian route, and you're trusting Gemini or whoever to hold your coins and give you 7%. Just giving you 7% on your dollars. Your rainy day fund can give you 7% in dollars, which beats your 8% in rands by far, because if you take depreciation into account and forex risk, so you could diversify. You could diversify into different stable coins, but I think if Tether goes down, everything's going down in the short term. But they're also all working on similar blockchains like Ethereum, which is also if something goes wrong with Ethereum, you're fucked with your.
I think for somebody that fully understands like crypto and the community and stuff, I mean that potentially could be an approach. And I hate to use the word term normie, but if you go to a normie and say, hey, this is you're going to chuck all your stuff onto this magic internet money, and there's this thing called Tether, and you can hold it there. It's going to be a tough sell for somebody that doesn't fully grasp the crypto environment. And so, I mean, that's where we've got to find our balance. And
I think there's definitely validity to that, Matt, because like what Brandon is saying now, like if Tether goes down, then Bitcoin goes down, Bitcoin would die, but the price will go down a lot. If Tether goes down, if Ethereum goes down, all stable coins die. So that's pretty hectic. So diversifying out of crypto is probably a good idea as your hedge. I wouldn't put my hedge against Bitcoin in crypto, because the market moves in unison there. So offshore property is probably quite a good one because you get stable growth and stable yield. If you own that property in a legitimate place where they're not expropriating your property, maybe, I don't know, not New York, not Berlin.
UK. No, the UK. For South Africans, the UK is probably the lowest barrier to entry, and also it's very easy to get a mortgage there. Interest rates are low, and there's such a high demand at the moment. So outside of London, so Manchester, Liverpool, Leeds, and they're building that HS2 at the side of the country. Everyone's moving outside of London. As you said, people are working remotely. No one's working inside, let's say, city centres. So there's a high demand. There's lots of universities. So we've seen the most growth there and the highest demand. And it's fairly easy. So if you can use that as your retirement, go buy your Bitcoin, go have your rainy day funds and stuff, I think you're in a good spot.
Yeah. But again, that's diversification. And this is something I've sort of learned via Jade. And I'm, as I said, exploring the option of UK property to offer to my clients. And you can pretty much be cash flow positive from month number one. Because in the UK, the banks actually, I want to say that there's less political risk, for example. So the bank is pretty much happy to guarantee the value of your property, right? So they've got something there which we don't have here, which is a interest-only mortgage. So you actually only pay the interest of your mortgage instead of trying to pay off the capital amount of the value of the house as well. You just pay the interest, and the bank's happy to do that because they're confident in 10 years' time that the value of your property would have increased. So in 10 years' time, when you want to sell it, you've paid off the interest portion, and you can then pocket the growth of the property. So your monthly payments are way lower. So instead of paying 800,
But Matt, that's so scary, man. because that just basically you're talking. That's the same thing as bonds being a 0% yield to me. Is that the bank's willing to charge no, interest.
No, they do.
Yeah, no. But I'm talking about your standard banking model, and it just shows you that somewhere it's ringing alarm bells in my head that you're at the top now at property prices, and everybody's overconfident, and this is ringing fucking alarm bells, dude.
Yeah. So I get you. But if you're gonna have to offer me to buy property in South Africa and you have that same risk, would I take it in South Africa versus the UK, which is going to be a safer bet? I'd rather go to the UK. But I'm just saying, so that is people that believe in property, because I come across clients that are, their dad was heavily in property and he did really well, and that's what they believe in. That's what they really want. Well, I'm going to try and do it for them, and I feel the best way possible, because you get those clients. That's what they believe in, and that's really what they want, and that's their dream, is to own property. Again, it comes down to I'm not going to put all your eggs into that basket, but yeah.
Can we get cosmic here for a second? So the reason why property goes up in value is because it's a network, right? And that network is your property rights of your country. And because the network is doing the work for you, in other words, other people's property values are rising as well, that drags your value up as well. And that's because the population is growing. And there's basically more people and less space, especially in the UK. The muddy little island hasn't got very much space to start with. So like property values go up as time passes and population increases. But so that's a network, which is just limited to the geographical confines of the UK. So this is where we segue into Bitcoin. Bitcoin is a network. And the reason why your Bitcoin goes up in value is because there's a limited amount that'll ever be created, which is decreasing in supply every 10 minutes. And the amount of people chasing after it is increasing every day dramatically. But the network is global. The size is global, and it is resilient because China now has just banned Bitcoin, right? They banned cryptocurrency transactions. And for the first time ever, I think, the network and the price did not skip a beat. Everyone's like, China, we are over your bullshit. You have no more miners. You have no power here. And that's beautiful to see. But so China can ban Bitcoin, for example, even though they can't. They're saying they ban Bitcoin, but it has no effect on your savings really somewhere else in the world because it's such a robust network. So I think everything comes down to the fact that everything of value really is a network, and it's got to be fungible. Otherwise, it wouldn't work. So when you think of property, you think of stocks, you think of bonds. It's all these fungible tokens that are networks within their own geographical location. In the case of US dollars, it's worldwide. But just to Brandon's point earlier, I think that the pride cometh before the fall, right? Like the property market in the UK now, everyone is super sure. The banks are so sure that nothing will happen. They're just willing to make you pay the interest on the loan only and not the capital. Sounds to me like things are getting a bit frothy there.
I think, listen, to be fair, I think they're also with COVID and everything, they're trying to, the banks are trying to help stimulate the economy a lot. They had that stamp duty holiday. So I think that it comes down to that at the moment. And I think people are obviously jumping on that, which I understand. There's a lot of places where people can't afford to buy. There's a huge rental market. Not everyone can afford to buy, but for the people that can, it's a good opportunity at the moment.
Yeah.
So, yeah, I mean, just funny enough, I was talking to a client in Zim today, and she was saying there's something weird has happened there with property, and there's like 5 buyers for everywhere, and the prices have just shot through the roof. It doesn't mean that things are good in the country there. It just, I don't know what the hell that means, but who knows what's going on there. But yeah, it's interesting to see what will happen. But I would far rather, having said that, put my money in the UK versus Zimbabwe. So
yeah.
A property market boom in Zimbabwe is it's a head scratcher, that's for sure.
But for a Zimbabwean person, right, that wants to own property, I mean, that's a great opportunity for them. They absolutely don't want to own in their own country. I mean, what kind of security are you going to get there?
Yeah.
I mean, I don't have to ask them that question of where do they see the country going? Is it going towards Zimbabwe or Singapore? They already know.
They already are Zimbabwe.
My country is the example.
Yeah.
So Jade, we were chatting before the show, but you're fairly a little bit newer to Bitcoin. Like, as you come from a very experienced background and like as well experienced and educated as you are, what's your plan with Bitcoin? What are you going to be doing with it? Are you going to be active, passive? what's your game plan?
If my heart can take it, I'll carry on. But I find it I'm very risk averse. So ask Matt, I was like watching it every day. I'm like, oh my gosh, it's dropped now, it's up, now it's dropped. So I've been buying, and when I think it's a low, and then it just seems to go lower. So I'm not very good at timing the Bitcoin, and not only Bitcoin, I've got quite a few other, cryptos that Matt's helped me with, like probably 10, I think.
Matt, you're introducing her to shitcoinery, are you?
That was on her own accord.
What a few. Yeah, no, but it's done.
Jade actually bought the first time she was getting into Bitcoin, she actually bought Bitcoin Cash by mistake.
And I bought Bitcoin Cash.
Yeah. So that was the early days. And I've sort of tried to guide from there. But
my Bitcoin Cash did better than my Bitcoin though, so I don't know. Initially.
Yeah, they're definitely initially.
Yeah. Yeah.
Is I found Matt's, so I've got quite a big portfolio now between Matt's and mine. No, I'm going to hold it. It's a long term, like it's too volatile I'm sure you guys probably give advice on holding it as a long term thing. It's not something I'm going to pull out of. I'm going to just keep on buying. I'm buying in pounds and dollars, so at least I've also got a hedge against the rand, and it's in a hard currency. So.
Well, I think if you got a portfolio, and I'm just actually not, I don't feel like being a toxic maxi today, so I'm just going to kind of, I'm allowed to advise on crypto now because it's not a regulated product. So fuck you, regulators. I'm allowed to advise on it. If you do want to hold your shit
that is
coin,
definitely going to be the introduction to this podcast. That's going to be the intro.
if you do want to hold your shit coins, you are a free person to do so. I'm a libertarian. You're more than welcome. I'm really not being condescending. But the way you got to look at it is that Bitcoin is a long-term thing where if you hold it, you kind of need to forget about it. You can carry on with your life. You can focus on work. You can focus on your hobbies. And you know you're in something solid for the long term. If you're holding shit coins, yes, and maybe 99% of them fail. That's historics. I'm not telling the future. It's based on historics. But you could get that 1% of 10,000 is 100, right? There's 100 out there that has the potential to 1,000x. But those 100, you have to be extremely active, quick, fast. There's manipulators everywhere. You got to be on the button. You need to be on Twitter all day. You need to be in the groups. So that's the way you got to approach it, because it's going to fall fast. It's going to go up high. And when it goes up high, it's like 2 days up, and then it's 50 days down. And you only got those 2 days.
Ask Elon Musk about Doge. He'll tell you.
You got to think about what's the life you want to live, what's your plan around that, and that's my advice to you.
Yeah, no, to be fair, I think like 70% is in Bitcoin and like 20% in Ethereum, and the rest is very little amounts in like Doge and I don't know, those other stupid coins.
So if I can
that's
defend,
so
if I can defend Jade here, she's very new to Bitcoin. And I think all of us go through that phase, right? When you get to Bitcoin and you started to Bitcoin and then you see these other coins and you see the big gains and but you need to learn. You got to learn. I mean, Ricky and myself, Brandon, I'm not sure how long you've been in crypto, but we were part of 2017 and we got into the shitcoinery and we gambled coins away. And, it was a learning process, right? And so you had to go through that. And I think Jade's there now. And I think a large part of the crypto community has to go through that phase, right? And the more you
everyone does essentially. There's like one or two people who don't, but like, yeah, we're not excusing my degeneracy, but it is what it is.
Yeah, you still got coins from 2017 that are still down.
Yeah, I keep them as a memento of my shit for shitcoining. So some of them I can never sell because they just are worthless now. Now I just keep them. They're basically NFTs. I look at and I'm like, I was fucking stupid.
So that's what you guys are here for, is to obviously, watch the market, tell us when to buy, not when to sell, because I'm assuming we're going to keep it.
We're still here to buy small amounts of Bitcoin every day. That's all I can advise.
That's it.
Yeah.
So ultimately, like, this ties back into the exact same way that you would invest into your RA or your pension or your rainy day fund, your tax-free or whatever. You never look at the unit price on any of those things when you're buying them. No one looks at the unit price in their RA and like, ooh, today's a good day to buy into my like Ellen Gray balance fund in my RA because the price is down. No, like you just average into the market on a monthly basis. And that's exactly what we recommend to people to do when they get into Bitcoin. If you can avoid it, like maybe start with a bit of a lump sum just to get some skin in the game, but that shouldn't be the majority of your position. The majority should actually be like over the course of a few months to a few years, just like pecking away at it, get a DCAing into the market or dollar cost averaging into the market, because then you don't look at the price every day because you're like, I don't know what I paid for it because I got in over the last 90 days. I bought every single day, 30 Rand a day. Like, I'm not looking at prices irrelevant to me now. I don't know if I'm up or down. I just know I have Bitcoin and my stack is growing. My sats are going up. That's all I know.
Yeah. So that's I think the best way to look at your Bitcoin value is not in US dollars or in pounds, whatever, but to actually look at how much Bitcoin you've got.
But like, going back to who you are, every investor is different. And if you want to have fun and you want to be active and you feel like you got a game plan, then put a small amount. Basically, and I've never told anybody, I'll never tell my family or friends, because they're not like that. But if you are, because you're experienced and you want to have some fun, then by all means, go and play some shit coins, and you never know what happens. You never want to know what happens. And I don't know, I'm feeling very weird today. I'm just not feeling like a toxic maxi. So you're free to do what you want.
£10 $2 isn't going to change anyone's life, just to see what, whatever.
If it satisfies your FOMO, your FOMO-ness, if you want to call it that. If you're sitting in Bitcoin and you're like, oh, Bitcoin's going sideways for the last 2 months, but there's a couple of shit coins that are doing something, and if you want to take $100 and just to satisfy that FOMO and go play around at the shitcoin casino, then cool, get it out of your system. But I would, my personal thing is keep it a smaller amount.
Yeah, but it's also, it helps. It works with your lifestyle. It works with your, if you're just doing that constantly, you have time to actually focus on Bitcoin. You have time to understand. You have time to read all the books and read all the articles and everything. And not even then are you even 30% of the way through understanding this thing. So try and do that with 10,000 other shitcoins. You can't. So you got to treat that as gambling. And you've got to treat Bitcoin with respect, and that's the way to approach it. And people just don't understand that part. But people are just on this get rich quick scheme, and it's just not that. It is not that.
It's get intergenerational wealth over intergenerations. Like, that's what it's about. It's about like getting Bitcoin and keeping it. And Jay, to your point about like $1,000 is not going to change anyone's life. If you get into Bitcoin long enough, that $1,000 could change your life. If you get $1,000 of Bitcoin now and you wait 20 years, it might very well change your life, to some degree. At least.
No, absolutely. But I'm saying I put like £10 into Doge, I think. I mean, that's not, I can barely call myself even a trader on, that amount. But I would never, so as I was saying, like the majority is in Bitcoin. So hopefully Brandon's happier now.
Yeah, but I sort of wanted to come across as if we're shaming you here and ganging up on you here. Like, the best way to learn about these things is like, look, maybe you figure out that, hey, you are actually a really good trader. And you are the 1% who can beat 99% of the market. And you're the one who takes everyone's sats from them. Because the reality of trading is that 1% of traders take 99% of people's money.
There are those people. There are those winners out there.
They exist.
And they're extremely clever people, and that's who you play against. So if you can be that clever, then go for it.
And they are rich as fuck now.
Yeah.
Until they aren't, because some of them get wrecked and they lose all the money that they've acquired over the last 5 years. They lose it all. It does happen. But it's a hectic lifestyle. That's another thing, such a hectic lifestyle, because the markets never stop. For 24 hours a day, you're just on your phone permanently, and you don't find peace. Well, I didn't find peace, and like my life is much better now that I don't trade.
But I think what's most important is that Jade's taken the step to get in the market. So I think that is, and then you learn. You've got your 70% in Bitcoin now, and so you'll learn over time that the shit coins generally fall up. They fall away. If you look at by market cap, you take the top 10 by market cap, and you look back 5 years. What coins other than Bitcoin were there that are there now that were there 5 years ago? None. But you've got to cut your teeth. You've got to pay your school fees. You've got to learn in the shitcoin casino. And as you go through that, it's a growing process, and you'll learn to you'll allocate more and more to Bitcoin as you educate and learn over time. That's how I've seen it. I won't call myself a maxi, but that's my thoughts.
But you've been around it for 5 years. You've been around long enough to see and to know kind of, and price everything in Bitcoin, because it's very easy to be blinded by your altcoin that you bought for $30 is now worth $500, and you're like, yeah, gains. But when you price it in Bitcoin, you put in 0.1 Bitcoin, and it's actually only worth 0.08 Bitcoin now, and you've actually gone down. You've lost some Bitcoin.
Yeah.
So that's that. You need to price everything in Bitcoin to get an accurate reflection of what's actually happening.
Exactly. So I've paid my school fees in that department, and I'll try and fast track Jade as well. Jade, I've known Jade for a few years, and she's seen me playing shitcoin casino, and I've learned my lessons. That turbulent part is behind me now. I'm not a Bitcoin maxi, but yeah.
You can get burned very quickly in this game.
Yeah. I think Matt, for those who want to hear the story in episode 21, how Matt got burnt by the ultimate shitcoin called Steinhoff. You should go and listen to that one. Basically, trading on leverage, trading stocks, got him wrecked, and then Bitcoin saved his ass. But yeah, it's a harrowing story that people should go listen to.
Forever indebted to Bitcoin, bro. That's why I'm still here.
What's Steinhoff trading at the moment? Actually, sorry to interrupt you, Matt. Is it
probably like
still in
$1.50? I don't look. I'm too emotionally scarred.
Guys, I was walking in Vietnam one evening in this like weird side alley in District 2, and it was like hardly any lights. It was a thin, quite walled, dodgy street, and I looked to the right, and there's just a Steinhoff sign in the middle of Vietnam in this dodgy building. I was like, wow, man, wow. Is that where the money is?
Yeah.
12 companies.
Yeah, I see Steinhoff is still trading at $3.23. So,
actually,
Matt, you made it.
What did you buy it, Matt? 97.
Yeah, something like that. I'm a lot more than what it is now. I'll tell you that much. But yeah. Again, Bitcoin.
Anyway, yeah. Guys, we are digressing slightly here. I just want to get into one last thing before we wrap it up. With offshore funds, there are the pure offshore funds, which are domiciled offshore. Your money sitting in USD, it's totally out of the country. So in other words, even if the government were to expropriate every single piece of every asset in South Africa, they couldn't touch that. But there's a high entry level, the high price requirement to get in. So like normally it's like 250K or something like that to get in. Then you have this thing called a feeder fund. Matt, can you just explain what a feeder fund is and how that's different from a pure offshore fund?
Okay, so a feeder fund, you're actually you're invested technically in offshore equities, for example. So it might be Apple or Microsoft, whatever the case is, but you're still in rands. So, and you're still based in South Africa in rands, and they do what's called an asset swap. So you're invested in rands, but you're getting the returns of an offshore equity fund, for example, if that makes sense. But the downside is, of course, you're still in rand. So you're still getting the benefit of potentially the rand depreciating. So you'll see your investment value go up in rands if the rand depreciates. But you're still on the local platform. And that's a good way to invest if you don't have the big lump sum of money to be able to go offshore. If you want the offshore exposure, but you don't have the capital available, that's kind of your first option. Because it's a very low barrier to entry. So that you can access easily on any list platform like Allen Gray, for example. And that can be up to 1,000 Rand a month as a point. And that'll get you into that. So that's a good starting point. Yeah.
Okay, great. Jade, you got anything else you want to add on feeder funds versus pure offshore funds? Downsides of feeder funds versus pure offshore?
Well, I mean, you mentioned being offshore, obviously it's domiciled there. Whereas, if you've structured it properly, no one can ever come after those funds. It's not in your name if but if it's offshore on a platform, they can, unfortunately. But yeah, ideally, you'd rather have it, it's not for everyone though, the entry points are a bit higher. But just, to grow your money, definitely start with the feeder funds and then, build up enough capital to structure it properly so that it can never ever be brought back to South Africa. It doesn't sit on your balance sheet. It's not in your name. But yeah, there's a scenario for both, definitely.
Can we drill down on that point? I know you mentioned the offshore trust you set up for your clients. I don't think we've dug into that enough. So you say you set up a separate legal entity, actually for the client. So it's not in their name, it's in a legal entity name in a trust or a limited liability company.
Yeah, so it'll be like a pension trust structure. I mean, obviously, I'm not going to give away our Coca-Cola recipe, to everyone to go do. But essentially, it's not in your name. It's not sitting on your balance sheet. No one can come after those funds. There's no winding up of the estate if something happens to you. The trust lives on, essentially. But I mean, that's pretty similar to the trust as you guys understand it and know it. But we take it one step further in that within the trust structure, you're investing in the best funds in the world, in the best currencies in the world, and you can live here pretty much off that, and you can live a good life. And if something were to happen to you, literally it lives straight on. It goes to your beneficiaries. There's no winding up of your estate duties like there would be in South Africa. If let's say you pass away, I mean, how many years can it take to wind up in the state? 2 years maybe, and then you've got all these taxes, executors fees, and goodness knows what else. Whereas there it's very clean, so it's a lot less stressful for pretty much everyone.
And that's something people underestimate here. The estate duties when you pass away is 20% in South Africa. So if you die, 20% automatically going to the government, which is fucking outrageous because you've paid tax on that money that you managed to save. Then you pay capital gains tax on it when you sell it. And when you die, you pay estate taxes on it. So effectively, they take like close to 100% of your money. Outrageous. So putting it into some kind of vehicle that doesn't die, like a trust, obviously you've got to weigh up the tax benefits, all of that stuff. But it is obviously very attractive then because now you pass away, your kids just have access to the trust. It's not.
I recently saw that they've kind of made trusts fairly redundant in South African trust, fairly redundant in Mauritius now with new legislation. But this is why I keep harping on about what's going to happen with financial services, especially what's going to happen with you guys in setting up multi-sig and contracts within Bitcoin to pass Bitcoin to beneficiaries upon a person dying, because you can build these things into this in the future. As Bitcoin becomes more, you can build conditions into your multi-sig setup that if you don't access it, that's an event, right? There's no event that happens. And no is like you haven't done that within 6 months, it passes to a set of addresses, which is your beneficiaries, which remain at zero. And things like that, and I promise you guys, that's going to be like whole financial services built around that. I fucking promise you. It's going to be massive. And there's no intermediaries there, but you have to have provided that service to set it up. And you have to maybe maintain it and they need to maybe update the conditions, and that's where you maintain the relationship and those kind of things. It's happening now. It's going to happen soon.
Yeah, sure.
Yeah, Brandon, on that point, like this is what gets me really excited because let's real talk for a second here. The world is becoming a more authoritarian place, in case people haven't fucking noticed. Like it's governments are clamping down all over the place, trying to take more of your money that they claim they have a stake to. And no matter if you've got it set up in a trust or in a limited liability company or in your own name, these are just varying degrees of barriers, but they will come for them. Like Mauritius is changing its trust structures, because they're bowing to international pressure. Bitcoin it can resist all of this because they can't do anything about it. And I think you're going to see big money because look, at the end of the day, everyone's a capitalist. When it comes down to the government taking more money from you, people are going to make a plan to try to preserve the capital. And this is where I think advisors are going to be good advisors and clever advisors who understand Bitcoin are really going to make money in the future and offer a lot of value to their clients where your clients like, listen, what options do I have here? The government's taxing me dry. What am I going to do? And you can say, well, there's this thing called Bitcoin. Let me set up a multi-sig so your kids can get hold of it if you pass away. And there's a lot to it there, So I'm very excited about that. I know, Matt, what do you think?
Yeah, I think that's where we can actually differentiate ourselves against a regular advisor in South Africa, to be able to offer real value and real advice. And I agree, like the government is coming after, especially that top 1%, right? It's easier to go after that 1%. There's less of them. So it's low-hanging fruit. So they're going to come after you, and you need to basically future-proof yourself. What is the best way? You need to do it in the best, most efficient way possible. And that's where I've actually started working more with Jade, setting up tax structures or trust structures and then helping educate my clients on Bitcoin, like what are the advantages of Bitcoin. So the guys that are really interested, I educate on them and I can help guide them. And then, yeah, I mean, from what they do with that from there is up to them, but I can at least make sure they're not going to get scammed and all that. But from an estate planning perspective, from future proofing and that kind of stuff, yeah, Bitcoin's incredible for that.
At least it's it's regulated in some states now in America, and that's a good precedent, and it'll happen soon in good countries. And good, I mean, it's pretty ambiguous, but you know what I mean. And hopefully that you guys can start advising people properly about it, because it's so fucking important to do so.
Yeah, exactly.
Just interesting, Brandon does. Sorry, Matt, carry on. Mine was a snide remark.
No,
not that important. You carry on, Matt.
No, I think that's where regulation can be really good for us, is that if it does come, we can actually really add value and help our clients. Because at the moment, it's a tough thing to do, because I want to help, but I can't. There's a certain line I can't go over. Obviously, Jade as well. We can't tread over that line. So if the regulation does come and we're allowed to do that, then I think it's actually really good for the majority of people, because we can offer good value and we can make sure that they're not duped.
Well, this is another thing, right? And like you said last time, your biggest job when it comes to dealing with your clients about Bitcoin is scam detection, right? Because there are so many scams out there. And because they use Bitcoin's good brand name, even though Bitcoin's never spent a cent on branding, like people attach themselves to it. The MTIs, etc. Like, I think that's the first port of call of an advisor, is to know how to spot those scams and advise their clients accordingly.
Yeah, I mean, just as a quick example, I was away this weekend and I was chatting to it was a mountain bike stage race, and I was chatting to a friend of mine who's a doctor, and he was chatting about Bitcoin because he knows I'm into it and stuff. He's like, "Yeah, this Bitcoin thing. I see someone was hacked again the other day. That AfriCrypt. Everyone's Bitcoin was stolen and Bitcoin was hacked." And I was like, "No, dude, that's not Bitcoin. Bitcoin is like the most secure thing on planet Earth." And I think it's that misperception. Like, people just don't understand it. They're not educated about it. So they hear something like AfriCrypt going down and they just assume Bitcoin.
You got to make it binary. You got to say, if someone's holding your Bitcoin for you, there's something probably wrong. Hold Bitcoin yourself, and you'll be fine if you know how to do it properly. And that's where the guidance comes in. And people just need to understand those things, because otherwise it's just everything becomes so diluted and complicated. You just differentiate by those two things.
Yeah, and that's where you guys have been really great. Like, it's great for me to direct them to your site. So if you guys want to learn, if you want to know about it, if you want a secure place to buy it, then go to Bitvice. These guys, I know them; they're legit. That's where you want to go to deal with them.
Yeah,
thanks, man.
Thanks, Matt. That's very, very nice of you to say. The one thing though is that I find a lot of very intelligent people who are highly qualified, who parrot this line about Bitcoin. I saw Bitcoin got hacked. Unfortunately, these are the same people who think News 24 is a news source. People need to adjust their paradigm that we're living in a world where information is not always your friend. You need to be very discerning about how you browse information, and your bullshit filter radar needs to be strong. And this is once again where the role of a trusted advisor plays everything about everything. There's no ways. So you need to defer to people on some things, but then how do you know that these people you're speaking to are in fact trustworthy? And this is where the regulation is supposed to function, to be like an arbiter of who's trustworthy, because they hold this position or this title or qualification. But unfortunately, that also is not always. That's being bastardized as we speak. Doctors, lawyers, accountants. Look around you. Like, we're kind of in the middle of an information war. Anyway, world's a crazy place. But I find safety in sats. I find safety in Bitcoin, because it's the only thing that I know is consistent and true kind of in this world, which is an interesting philosophical point. And kind of why maybe Bitcoin's developing into a religion. I mean, it's past cult phase already. Satoshi's disappeared, so now it's a religion. And I think it's a full-on religion already, guys. And Brandon and I are definitely approaching priesthood. Anyway, on that bombshell. Cool, guys. Yeah, I mean, that's it, right? Like, that literally is it. You're going to see a lot of clever people get taken for a ride. Unfortunately, there's a lot of doctors and lawyers and engineers who lost money in MTI, and they shouldn't have. There's no reason why they shouldn't have,
I know financial advisors that lost money in MTI. People that should know more.
I mean, Matt, we know Matt, we know financial advisors who recommended MTI to their clients.
It's also true. Yeah. It's scary actually.
Yeah. Anyway, guys, tell me, Jade, if people want to find you, get hold of you, and speak to you about offshore investments, where can people track you down or follow your work?
They can phone me, they can email me. I'm assuming you guys are going to put up a post or something on LinkedIn. You're more than welcome to reach out to me on LinkedIn. Obviously there's no obligation to just have a chat. They don't have to do business. They're more than welcome to just set up an appointment just to chat.
Okay, great. So we'll put your email address and a link to your website in the description of the video. Matt, where can people track you down?
Yeah, I think the easiest is also LinkedIn. I'm quite active on LinkedIn, so if you pop me a message, get in touch. Alternatively, also via email. Either way, same thing as Jade. I work a lot with Jade because of her expertise and the products that she can offer that I currently don't have the ability to do so. So either way, one of us will help you. And again, just to mention, the last show was really successful. We had really good feedback. Chatted to a few guys. I saw a lot of value in the show, and a few guys asked me, what do you charge just for a consultation? I'm like, well, let's have a Zoom. It's 30 minutes. Let's have a chat. Let's see how I can help you. So yeah, don't be shy. Absolutely, reach out to Jade or myself, and we can see if we can help.
And that's I think what we're trying to get at as a big takeaway from this is like, look, there are Bitcoiners out there that are not all maxis. Like we do, not everyone's in the cult yet. I get that. But there's Bitcoiners who have existing financial products, and like they have the right to get the best quality advice they can and be in the lowest fee, most efficient products. And like knowing that there's other advisors out there who understand this and are Bitcoiners themselves, like that's who you want to speak to. And that's exactly why we've got the two of you on the show, is to be able to put Bitcoiners who are, or our audience, in contact with financial advisors who are trustworthy and actually know what they're doing. Because it's the advisory landscape is a treacherous place.
Absolutely.
Yeah. And then, sorry, just I'll jump in before we end the show. I think what's really, really cool is that the feedback that I got from guys is to have a show that is actually South African. So these guys have products that are South African, and the rest of the podcasts and stuff you see on YouTube is UK, US based. They don't have actually a reference point to their products in South Africa and what's available in South Africa. So yeah, I think kudos to you guys for putting on the podcast and having us on the show where we can actually chat to our audience and they can actually relate specifically to what they have, and we can offer them solutions that's here in South Africa, in our own country. So yeah, thanks. Well done to you guys.
Thank you very much. That's what we try to achieve here. Cool, guys. Thank you very much for your time. Fantastic having you on the show. Very interesting conversation. Brandon, as always, thank you very much. Anything from your side?
All good. Thanks, guys.
Okay. Cool, guys. Have a good evening.
Thank you. Cheers. Thanks for having me, guys. Thanks. Have a nice evening.
Bye.